Greetings, everybody. Welcome to Liberty Call. Today is Monday, March 20th, 2023. Hope everybody's had a fantastical weekend. I had a pretty good weekend myself. Cougars won both of their games Thursday and Saturday, which was really good. And great weekend for the tournament. I'm sure there's a lot of fellow basketball fans out there like myself who parked their ass in front of the TV pretty much from Thursday till Sunday afternoon, evening. So I did give the wife the TV back Sunday night so she could watch some of the shows that had been building up in the DVR. But, I'm not too terrible of a person. But got to watch an Astro game yesterday that was on MLB Network, which was pretty nice. And they lost. But hey, I'm a big believer. The worse the spring training record is, the inverse occurs during the regular season. So as long as the Astros can have a terrible spring training, go out there and try out all your farm hands and stuff like that. Let them get some seasoning, and then by the time into March, April rolls around, even though we're going to be down, Mr. Altuve got a busted hand. But I did watch the World Baseball Classic, both games the U.S. played. Unfortunately, the U.S. kind of broke Jose's hand or thumb, but he should be back in a couple of months. So we'll be all right as far as Astros. All right. If it's your first time watching, please give me some thumbs up, likes, shares, subscribes. And let's go ahead and dive into the numbers. Things certainly look better today if you're an equity holder at the moment. The Dow Jones was up 1.2%, or 382 points, closed at 32,244. S&P 500 up 0.86, closed at 3950. NASDAQ was up 0.39. It was in the red a lot today. It was up 0.39, closed at 11,675. The VIX fell today 5.41%, currently holding at 2413. So, the markets, looking at the overnights, looking at the overnights or the futures, last night before I went to bed, woke up about 2, checked the futures again, and they were seriously in the red. I was shocked this morning when when I get down here to my office and it's like everything's in the green. It's crazy. So, all right, let's get back to it. Canada was up 0.68, Brazil down 1.04%, Mexico down 1.1%. Headed over to Europe, Germany up 1.12, UK up 0.93, France up 1.27%, Netherlands up 0.92, Spain up 1.31, Italy up 1.59, Switzerland up 0.28, Portugal up 0.79. Russian exchange is both green. MOEX up 3.2%, RTSI up 3.25%. And like I said, there were a lot of red overnight here in the Asian markets overnight. The Nikkei in Japan was down 1.42. Australia was down 1.38. New Zealand down 1.18. Chinese markets all red. The Shanghai down 0.48. The Shenzhen Component down 0.27. China 50 down 0.41. DJ Shanghai down 0.45. Hang Seng down 2.65%, and I see no change on the Taiwan weighted right now. All right, so like I said, something happened overnight. I guess it had to do with UBS bailing out Credit Suisse, and gave everybody the warm fuzzies, and they're like, "Oh, good, let's go ahead and just push money back into the market because things are fine. They're okay. Nothing to worry about at all out there." We know that's not true. All righty, well, let's go ahead and jump on over to the weekly economic update. Starting out with the week on Wall Street, amid the reverberations of 2 U.S. banks being taken over by regulators and the spread of uncertainty to European banks, stocks trended higher last week on the strength of the technology sector. The Dow Jones was flat, down 0.15. S&P 500 was up 1.43%. NASDAQ was up 4.41%, and internationals were flat at up 0.05%. Stocks gained despite banking woes. Stocks prices gyrated as investors wrestled with banking troubles that appeared to spread to Europe. Worries of financial instability rocked financials and sent bond yields falling. While the rush into treasuries was expected, the dash into technology stocks was a surprise. Falling yields made by high growth names more attractive, though investors targeted their buying in high quality companies that offered defensive characteristics such as profits, healthy cash flows, and strong balance sheets. Boy, those are things you should probably look at anytime you're buying an equity. Are they profitable? Do they have good cash flow? And do they have a strong balance sheet? what else are people buying on? Just, throwing, darts at the financial section at the newspaper. And all right, we're going to buy today Coca-Cola. I mean, seriously, people. When Switzerland's central bank provided a lifeline to a troubled Swiss bank and a group of U.S. banks provided aid to a struggling regional bank, stocks powered higher on Thursday. Banking jitters, however, returned on Friday, closing out a tumultuous week and pairing some of the week's gains. Reverse psychology. Less than 2 weeks ago, Fed Chair Jerome Powell testified interest rates might have to be hiked higher and faster. Since then, 2 U.S. banks were placed in receivership, sparking worries of financial instability and changing the market's outlook on future rate hikes. Yeah, a lot of people are hoping that the Fed is going to stop raising rates. And actually, I'm going to bring a chart up here in a minute, so we'll give me a second here. The question now is if the Fed will hike short-term rates at all. By Thursday, traders saw an 18.1% probability of no rate increase at the Fed March meeting, which concludes this Wednesday. Just a week ago, there was a 0% chance. Traders also see a 0% chance of a 50 basis point rate increase in March. A week earlier, there was a 68.3% probability, where the market previously saw little likelihood of a rate cut this year. The probability of a rate cut by July was 63.7% by Thursday. Again, these people are just hoping and praying that interest rates are going to start going back down and they're going to do QE and money printing, which again, it's kind of like taking heroin. You feel good for, an hour, day. I don't know. I've never taken it. But, the next day you feel like crap. You're puking. You got the shakes. We're going to go through this same thing all over again, folks. All right, economic data coming out this week. Tuesday, we have existing home sales. Wednesday, we have the FOMC announcement. That's when the Fed chair is going to say whether or not they're raising rates again. Thursday, jobless claims and new home sales. Friday, durable goods orders and the PMI composite flash. Companies reporting earnings this week. Tuesday, we have Nike. Thursday, we have General Mills and Darden Restaurants. So pretty light week when it comes to earnings. All righty, well, let's go ahead and bring up the, before I do that, bear with me for a second because I did want to show what the Fed has done. Let me get my chart here for my presentation. Here we go. I had to find the hyperlink so we can talk about it. Copy. Close. All right, let me bring this up here. All right, this is the Federal Reserve's balance sheet. And let me bring it up on the screen here. And we can see, and I know my clients are probably sick of me talking about this, but we can see this is the Fed's balance sheet going back to, 2002. It was pretty low. Then we had the mortgage crisis. The balance sheet grew from under $1 trillion to, $2 trillion. So they're basically $1 trillion worth of TARP, if you remember that acronym. And then during the Obama years, it grew and grew and grew. Then Trump came into office and it was flat and it started to go down, then went back up. Then we had the whole COVID nightmare. So we got up to about $9 trillion here on the Fed's balance sheet. And what they were supposed to do was, starting last year, was allowing either selling or allowing these securities as they matured to just roll off their balance sheet. So let's go to the 1 year and we can see. So we start again. We were close to $9 trillion at this time. Actually, let me do see, where were we at the peak? We were just under 9 trillion and go back to the 1 year. And we gotten all the way down to about 8.3 trillion. So we, I say we, the collective we, the Fed had allowed about $700 billion to roll off their balance sheet. Well, in 1 week, it's already back up to 8.6 trillion. So they added about $300 billion to the Fed's balance sheet in a week. I don't think that's what was the amount of losses that were incurred by these banks. So again, just curious as to, they undid basically a year's worth of progress in a week's time. So, my expectation, and let me go back to it. My expectation is that the Fed will probably in the long term, go right back and, grow that balance sheet, do a bunch of more money printing, and then we'll be back in another mess. All right, let's go ahead and get to today's market recap. S&P 500 jumps as banks rebound on UBS-Credit Suisse deal. All right, where's my notes? Here we are. On Monday, the S&P 500 rose following the announcement that UBS would acquire struggling rival Credit Suisse in an emergency rescue deal worth $3.2 billion. This news lifted sentiment on banking stocks just ahead of the Federal Reserve's two-day meeting. The U.S. Central Bank has also stated its readiness to respond as necessary to preserve the Eurozone stability, further boosting financial stability in Europe. The rescue deal for Credit Suisse helped strengthen sentiment on banks, with Fifth Third Bancorp, Lincoln National Corporation, and NYCB leading to the upside. NYCB jumped more than 33% as its subsidiary, Flagstar Bank, agreed to buy a larger part of Signature Bank following the bank's recent collapse. However, First Republic Bank plunged by more than 41% after Standard & Poor's cut the bank's credit worthiness deeper into junk territory amid ongoing liquidity concerns. SP said that the move is unlikely to solve First Republic's liquidity problems and warned another downgrade was possible. Tech was also pressured by a slide in Microsoft Corporation and Amazon Inc., with the latter announcing 9,000 job cuts in its cloud hosting division, Amazon Web Services. A climb in U.S. Treasury yields also kept a lid on tech just ahead of the Fed's two-day meeting, which will kick off on Tuesday. At the conclusion of the two-day meeting, the Fed is expected to hike rates by 0.25%, but much uncertainty remains about the path forward for further hikes in the wake of the turmoil in the banking sector. About 70% of traders expect a rate hike, but Goldman Sachs said it expects a pause at the March meeting this week, quote, because of stress in the banking system, end quote. Energy stocks were in the ascendancy, shrugging off a wobble in energy prices amid ongoing jitters that the banking crisis could hurt global growth and energy demand. APA Corporation, Hess, and EQT Corporation led the gains in energy, up more than 2% on the day. Goldman Sachs nudged down its Brent forecast to $94 per barrel for 12 months ahead from the $100 previously, stating that, quote, oil prices have plunged despite China demand boom, given banking stress, recession fears, and an exodus of investor flows, end quote. In other news, Virgin Orbit Holdings is reportedly planning to file for bankruptcy should the commercial space company fail to secure funding, according to several media outlets. Its shares sunk 27% overall. The acquisition of Credit Suisse by UBS helped lift banking sentiment, but ongoing concerns about liquidity and potential downgrades kept gains in check. The tech sector was pressured by job cuts at Amazon and a climb in U.S. Treasury yields ahead of the Fed's two-day meeting, while energy stocks remained resilient despite ongoing jitters. All right, so things are a mess out there, folks. Just be careful. All right, next up on the docket, it's an article from Mises Wire. It's titled, "It Turns Out That Hundreds of Banks Are at Risk," authored by Peter St. Onge. All right, let me get my notes up. A recent study has suggested that the U.S. banking system is facing a fresh financial crisis, with two studies estimating that unrealized losses in the system are between $1.7 trillion and $2 trillion. This would erase up to 91% of their combined capital cushion, which currently stands at around $2.2 trillion. Furthermore, a brand new study from Stanford and Columbia has found that 186 banks are in distress, possibly to the point of seeking a bailout, with hundreds of banks in worse shape than Silicon Valley Bank. The rapid rate hikes by the Federal Reserve, combined with a crony banking system, are driving hundreds of banks to the edge. Fractional reserve banking and the Fed's lender of last resort, permanent bailout, have driven banks to permanently drive as fast as possible to the edge of the cliff. Together, the moral hazard has given the green light to reckless behavior. The Fed hiked rates at the fastest pace in 50 years, from 0 last March to 4.5 to 4.75 today, to cancel the inflation they caused by financing $7 trillion in deficit spending and COVID lockdowns. These hikes savaged long bond prices, which fell by 20%, feeding an estimated 10% plunge in all bank asset values. The bank thought it had $1 in the vault, but in reality, it only had 90 or 80 cents. For high flyers like Silicon Valley and potentially hundreds more, it was more like 60 cents in the bank. Last week, $152 billion in loans went out to the Fed's through the Fed's discount window, dwarfing even the worst of the 2008 crisis at $111 billion. You remember that number, the asset chart of the Federal Reserve? That's where part of that money is coming from, or a large part of it. The writer predicts trillions of dollars in bailouts, driving inflation back towards last year's highs, perhaps even into double digits, while the economy careens into recession and potentially stagflation. I think we're going to have the depression part two. I think that, we're going to have Civil War II, depression part two. And I think when we come out the end, once we get rid of all the, bottom feeders and parasites who suck on the government teats, get rid of the federal government, boy, life is going to be great. I'll get to keep most of my money that I make, and I won't have to worry about stupid federal laws and all the stupid stuff there. All right. Let's see. Diving back in. To protect oneself, the writer suggests investing in hard assets such as Bitcoin or gold. Again, this is not financial advice. This is his opinion. While big swings in the markets and prices are likely, it is important to remember that the first goal of investing is being able to sleep at night. So keeping the powder dry until the smoke clears may be wise. So yeah, it doesn't look like the banking system's in good shape either. All right, last article here. Heading towards a national bank. Sticking with the old banking premise. All right, and this comes from our friends over at First Trust, the chief economist, Brian Westbury. All right, where'd my notes go? All right, here we are. This article argues that the Federal Reserve, lawmakers, and regulators are slowly designing a financial system that resembles a national bank. He points out that the government attempts to remove risk from the financial system by have unintended consequences that lead to more risk and a larger government presence in the economy. Mr. Westbury cites several examples of how regulatory responses to past crises have created a perverse incentives that ultimately subsidize government borrowing and encourage more spending. The article then goes on to discuss how the 2008 financial crisis led to massive changes in the monetary and banking system, including a huge increase in the size of the Federal Reserve and a more stringent regulations on banks. He also notes that the Fed's balance sheet has grown from $875 billion before the crisis to over $8.6 trillion, primarily through the purchase of Treasury debt. The Fed also pays interest on bank reserves, which has become a significant source of income for banks as short-term rates have risen. He argues that the recent failures and rescues of banks, despite all the new regulations and the massive Fed balance sheet, prove that the current system is not sustainable. The government has stepped in to guarantee all FDI-insured deposit accounts, and depositors now know they are protected, which leads to seeking higher deposit rates regardless of the bank's riskiness. Meanwhile, the bank's managers generate outsized earnings until they go bust, at which time they are rescued if they play the political game of supporting the right causes. And you know what I'm talking about, woke crap. The article then concludes by warning that if taxpayers lose money, many of them will want the government to have more control, not less. The government may then cut out the private sector middlemen and allocate capital for political reasons. Mr. Westbury emphasizes that there is a time to change direction and short-circuit this process, but with each new crisis, the window of opportunity to act grows narrower. So not good stuff, folks. Again, we don't want a national bank. We like if you like having freedom and being able to access your money without governments and our overlords telling you what to do, you want to have freedom in where you handle your finances. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope everyone has a wonderful evening, and I'll talk to you next time. Adios.